Hi, I'm Mike Cerrone with Mastermind Agent, and this is the Referral Mastermind call. If that's what you're here for, you're in the right place. This is where we talk about how to get more repeating referrals from your friends, family, and past clients. We're going to have a really cool topic today, by the way. Pretty excited to share an idea with you. But let me just give a quick outline. What we do is we talk about three things. One, I give you a new idea and kind of bat that around a little bit. And then number two, we go ahead and open up for Q&A. Any questions you might have about how to get more repeated referrals. We'd like to jump into that and help you flesh out any ideas you have. And then number three, we go into anything you would like to chat about concerning your real estate practice. That's in phase three. So if you have those kind of things, keep those towards the middle or the end of the call. All right, so let's go ahead and get started with this idea I have for you. I've been looking out at the market and the changes in the market, trying to figure out where the opportunities are. It's something you should be doing. I'm sure you are. Depends on where you are in the country as to what challenge you're experiencing right now. If you are in the western part of the United States, you're experiencing a challenge with a shift in the market since basically June of last year, where prices have actually declined. In some markets, 5-10%. Some are actually as high as 20%. I even saw one where a county was down 33% in California. Kind of shocking. Now the South, some of the areas in the South are experiencing that. Again, real estate's a local phenomenon. So your current area is going to do whatever it's going to do, and that's what you need to know. But you got to kind of look at the bigger trends to see if they're going to affect you or not. So that's why I'm trying to give you a big picture. Down in the South, say in Austin, Texas, they're really struggling, right? They were a real high flyer. Now they're really hurting. A lot of the high flyers are the ones that are hurting. Like in the West, up in Idaho, they're struggling up there. Arizona, Las Vegas, etc. Some areas down in the South are doing a little bit of this turn and struggle. Maybe, maybe not. Depends on where you are. The Northeast and the Midwest, though, does not seem to be having a turn yet. I'm talking to some agents up there, and they're still having some fast market issues. I just want to point out that in our last big recession or change in the market that happened a long time ago now, back in, again, it depends on where you were, 2005, 6, 7, or 8, one of those years it hit you. But think about what I just said. It took a couple of years before it hit different markets. I don't think it's going to take that long this time around. It's happening quicker because it was artificially inflated. Again, I'm trying to get to the opportunities, but you got to kind of see what the picture is in the market and where you're at. So I anticipate that that's going to continue. I've been looking at trends. Some basic information, right, that you all know, but I'll point out the interest rates have been bumped up. They've been doubled from, some people are getting 3% or less on a 30-year fixed. Amazing. Never thought I'd see that in my lifetime. And now they're 6-7%, depending on what day we want to talk. And the Fed is still talking about tightening. The Fed is what's affecting these interest rates, because that floats through all the financial industries. And so it starts with the Fed, and then it works its way into mortgages and mortgage rates. And so as the Fed has raised its rates, so as all these other institutions, banks, et cetera, and all the way into mortgage. So you kind of want to watch the Fed and what they're doing. And they just had some bad news last couple of days where inflation is continuing. They thought they had it kind of more under control, and then boom, the rate almost doubled from what they expected between December and January. I know this sounds weird, about 0.6 inflation, which doesn't sound like much, but that's a month, so that's like 7% per year. And they're trying to hit a target of 2%, so they're freaking out. And so what that means is that they're going to continue to bump up rates. They're not doing it as fast as they were at the beginning, but they may. If you look back when we experienced this before, which was the 70s and 80s. And by the way, that's going to be my talk for today, is looking back at what other people did in the 70s and 80s, because I think it's going to give clues on how we can handle this today. But if you look back, Jimmy Carter, poor guy, he had this inflation thing start up in the 70s. basically because the guy before him, Nixon, had taken us off the gold standard. And, without going into a long speech, that basically created inflation, and it kind of got out of control. And then Reagan came in and he tried to figure it out for 4 years and wasn't getting a handle on it. And people were getting pretty desperate. And if you lived through those times, and interest rates were going all up on everything, including mortgages, inflation was happening all over the place. OPEC was doing its thing where it was creating constrictions. All these little factors were creating problems. Sound familiar, by the way? All these things kind of come from left field. And they were trying to figure out how to get a handle on it. And Paul Volcker came in as the Fed chair. See, all kind of starts with the Fed chair. And he basically started to not try to control interest rates, but instead try to control money supply. And the result was they had a big constriction in the economy. Very painful and difficult, which is probably where they're going to end up going with the Fed if they can't get control of inflation. It's what they're trying to avoid by trying to bump up the interest rates. You got to kind of understand a little bit of this because your clients are going to be asking you. So you at least have to kind of have an understanding of what they're talking about out there. The big picture is, where's the opportunity? I want to keep coming back to that. But you got to lay out the problem. And so now we're experiencing something a little bit different, but similar in that we have this inflation going on because the federal government infused all this money into the economy, trying to solve the problem of COVID, and the problem not being COVID, but the problem being that people weren't working. If you recall, in the early days, everything was shutting down and it was getting really weird. And by the way, I think they did the right moves with what they could do. And we have all the problems that came from those moves. But if they didn't do the moves, who knows where we would have been? Probably would have gotten a recession a lot faster, and maybe even a lot deeper, and maybe a depression. And so that's why they were trying to avoid it. So I understand what they were trying to do, and you probably do too, but it's still a problem for us today because now we got this inflation thing. All right. The problem is that interest rates have gone up and affordability now on houses has gone down. So people can't afford the mortgage payment. I've been playing with a little project to try to help some renters get into properties. And I've got all these people that want to get into properties, but when they look at their rental payment based on what the house payment is going to be, it's such a large gap that they just say, no, I'm not interested anymore. So like in my area, I'm in Metro Denver, if they're paying $2,000 in rent for a typical apartment, 2-bedroom apartment, even a house will probably be in a $2,500 or so for rent. But if they go to buy a house, a small house, a starter house, okay, if they're going to do that, their payment is now $3, $4, $5 a month, depending on where they are and what they're looking at. Well, that gap is so big that to pay an extra $1,000 or $2,000 a month that they just say no way. So this is a chart you need to start looking at, by the way, in your market, is look at the affordability of what is the typical payment, PITI, in your market versus what's the typical rent. And you need to look at the variation between those. Again, in my market, it's about double. So most people to get what they want, we're just talking starter homes, they're going to have to bump up extra $2,000, and they either can't do it or don't want to. I'm talking to people who even can do it, and they don't want to do it because they're smart and they see what's going on in the market where they think there's going to be a change and a fall off. And if you were seeing that, anticipating that, then you would not want to make a change right away either. The reason I'm bringing all that up, I'm sorry for all the digression, but first-time home buyers, they drive the market. Okay, you have to have a first-time home buyer to buy the starter home, so the starter home person could move up to the move-up home, so the move-up home person can move up to the higher-end home, and the higher-end home can buy a luxury home. Unless you're already in these upper stratospheres where you're buying the things with cash, but even those people are struggling because their businesses are hurting. So, everything is getting kind of affected from all different angles. And the question is, keep coming back to this, where is the opportunity? So, for looking at an opportunity. And by the way, I'm actually getting back to repeating referrals. If you'll follow me on this long journey I'm taking, but where the opportunity is where I think things are going is that if you continue to have this affordability problem, the price, something has to go down. Let's just say that. Something has to go down or something else has to go up. Let me make it even clearer. What has to happen? Either people's incomes have to go way up. Okay, because we talked about that affordability gap. So your typical person has to double their income. That's just not likely to happen. I mean, wages are going up, but wages are a lagger. I used to study economics. Wages are always the last thing to change when you have inflation. Inflation is an ugly animal all around. That's why the Fed's try to get out of it. But anyway, the last thing to change is wages. So it's just not likely to happen. If it happened, that would solve the problem, but it's just not likely to happen. What else could happen? The other thing that could happen is interest rates could go down by half, right? Go back down to 3. And that's not likely to happen. The Fed is saying, no, we're not going to do that. And I'm trying to track the financial people. They're basically estimating that we're going to be at this interest rate or higher over at least the next 18 to 24 months. And as more time goes on, they keep stretching that out. So they're getting more and more nervous. If you look at long-term cycles, when you go in a down cycle, they basically can go 5 or 7 years. So, keep to use that information as well, which plays into a solution I have. All right, so I don't have this formally written out. I should have maybe made some better notes, but let's keep walking through this. So we've got this issue where the affordability is a problem. Yeah, so the solution could be interest rates go down. Not going to happen. So what's the only thing left? There's only one of the 3 left, and that is going to be price. Price has got to come down. If the price of a home comes down, it brings the affordability in line, and now somebody who's renting could buy that home within rent, maybe slightly more or slightly less, but within the rent zone, not double their rent. That just becomes impossible to do. And so it doesn't happen. So that's probably what we're already seeing in the West for the last 6-7 months, and probably what's going to happen through the east side of the country as well, just because something's got to give. Sorry, I'm trying to let people in as well. So again, where is the opportunity? If we look back to what happened, I'm going to give a couple other points here. If we look back at other recessions or downward trends, if we look back into, I'm going to call it the 08, because that was kind of the middle of it, or everybody was already in it by 08. If we go back to the last Great Recession, what were the solutions that they came up with? What were the opportunities if you were a real estate agent? And if you were around, you know what they were. They were REO, real estate owned, working with a bank. That was an option. And by the way, if you like that idea or you did it before, you should start maybe brushing up on your skills there, because that's a possibility. It's not here yet, but it's probably, if things continue the way they are, it's probably going to be here in 6 months to a year. So REO is an option. The other thing that plays into that is short sales. So you're working with banks in a short sale, a seller owes more on their property than the current value of the home. They don't have any money to make up the difference in cash, which is an option, but if they don't have the cash, they can't do it. And so what happens for those folks is they can go to the bank and ask the bank to take less short sale, taking a short on the loan. A couple of kinks and problems for them on that, by the way. If you do get into that area, make sure you get a release of liability for the seller, which doesn't always happen. They have a problem with if they had any debt forgiven, they have to show that on their taxes as income. So, and their credit goes bad. There's all kinds of problems. By the way, I'm bringing that up because I have another idea. But that's a solution that you could get into and start doing short sales. They're hard. They're very difficult. If you haven't done one, they're tough because you got to get this bank to agree to take less, and they don't like that at all. And it takes a while for all those systems to play out. That's what happened in the 08s, but that was the opportunity, was REO and short sale. And then if that's on the sell side, or a very motivated seller who had a lot of equity. If you had motivated sellers with a lot of equity, then you also had the opportunity to work with them. By the way, so that's your PCSOI, repeated referrals. Keep in contact with those folks. That was also short sales. It was typically somebody you knew in your sphere. You were trying to help them through a difficult situation. And then REO is different, though, that your client is the bank. And a lot of agents did well with that, although it is a struggle and it's not as profitable as a lot of people like to say it is. So make sure if you go that route, you really dig into it and get good at it. But again, those two opportunities are probably about 6 months to a year out, in my estimation, if things continue the way they're going. If you flip on the other side, though, on the buyer side, where are the buyer opportunities in those kind of markets? Well, on the buyer side, it's going to be investors. That's who is buying up property in those down markets. people who had some free-flowing cash, people you may have in your sphere, people who own businesses or other things where you have a lot of free-flowing cash, or a high net worth individual or high income person, doctors, lawyers, whatever. These people who have a high income, they're going to have some cash for the investment side. The other one is first-time home buyers. Notice I'm swinging back around to first-time home buyers. Those folks can help drive the market. They have the opportunity. They're in a rental. It's easy for them to flip over the house. If the house values have come down enough, now the affordability is there. It's a great opportunity for a first-time home buyer to pop in. So if you like working with buyers, that's an interesting opportunity. Looks like some people are having a couple tech issues there. Hopefully they'll get worked out. Whew, boy, this is a long one. Just kind of came up with this idea, by the way, right before the call. So that's why I'm kind of, thank you for being my guinea pigs and let me talk about this for a second. So that's what I see there. That's what the opportunity happened for. That's going to be an opportunity again. I think there's another opportunity though, and it just kind of dawned on me, and I'm going to kind of throw it out there. We maybe just shop this a little bit. I had to give all that background for an understanding. If we pop back to the challenge struggle before the Great Recession, now you're going back into the 70s and 80s where people were experiencing what we're experiencing, which is interest rates jumping up. I was a kid at the time. You know, I could see on the shelves where they started to do generic products. I don't know if you're as old as me, they would do generic products, black and white products on the shelf. I remember my mom buying it and going, "Oh, that stuff is terrible. I'm not going to do that again." But you know, everybody was trying to figure out how to save a penny, and of course, we're starting to feel that again today. People are flying through their savings, etc. But let's keep going. What did they solve? How did they solve the real estate problem back then? The real estate problem back then was they had these interest rates shooting up, and in fact, at the peak in the early 80s. It got as high as 18% on a 30-year fixed. So don't think that it can't go any higher than 6 or 7 or whatever it is today. Most of my career was between 6 and 10 when I was working in the 90s and early 2000s for 17 years. But if you go back there, what did they do in the 70s? Their interest rates it was very common for them to do 10 and 12 and 15 and all the way up to 18 on first. And then they were doing seconds that were even higher than that because it's a riskier loan. They were getting into the 20s. I know it sounds insane, but that's what was happening. Hopefully we don't end up there, but that's what they were dealing with. And yet people were buying and selling homes. People were buying and selling homes in the 70s and 80s. The market didn't stop. Poor old Lynn's got a problem here with her computer. I'm sorry, it's kind of flashing in my eye, and I don't know if I can help her out. But anyway, I thought maybe I could make a change, but I can't. All right, so what did they do to solve that problem back in the 70s? In the 70s, if anybody was old enough or can think back long enough, here's what they came up with. They came up with the idea of assumptions. Wow, that was a long-winded speech for me to get to this one. But their solution was an assumption. An assumption is where a seller owns a property with an existing mortgage, and a buyer comes in. Now, the buyer can get a new financing at the current rate, which at the time is very high, 18%, 16%, whatever. Or the buyer could take over the seller's old loan with a 5% or 6% mortgage rate. I mean, the rates were so far apart. It was a huge incentive and a reason for this buyer to want to take over this seller's mortgage. And so agents, us, we figured out how to build this market and make it happen. Okay. We went to the banks and said, "Hey, well, let's read your note. Okay. And see what's in that note, that promissory note, that mortgage. Can it be assumed?" And a whole industry popped open in this assumable world. The assumable world just took off. If you look at any of the old real estate investment books back at the time, it was over a decade that they were dealing with assumptions. And They had an advantage that we don't have today, but I'm going to still keep going down the line. What they had was they had two kinds of assumptions. Again, let me spell that out what it is. A seller has an old loan, a buyer comes in. Instead of getting a new loan, the buyer takes over the seller's old loan, and the buyer moves forward on the payments on the seller's old mortgage. Okay. Now, there's all kinds of issues and challenges with that. And if you get into this, you got to be really careful and understand what's going on. For instance, the seller still has liability on that mortgage if the payments don't get made. That's why the seller needs to get a thing called a release of liability. Okay. There's all kinds of little gotchas you got to learn about if you're going to go this route, but the advantages are huge for the buyer. The buyer is getting this low interest rate, low payment loan. The seller is getting their property sold, and often the seller can sell their home for more money than they would if they sold it out to a regular buyer because they got this special financing. Just think when you go to buy a car, what do? They crank up the price of the car, but they'll subsidize the interest rate on the loan and they'll stretch out the amortization on the loan because everybody's looking at monthly payment. So people will pay a lot more for a car because they get this special financing and they get the payment that they want. That's the bottom line, is that the payment they want. So what you're doing is you're solving this problem, the payment problem, the affordability problem with this buyer and the seller. The buyer now gets a lower payment. The seller gets out of their home and again, probably sold for more than they would have if it was a regular buyer. And that was important because maybe if the market is like we're doing now and declining, they can actually sell their home without having to take a hit, where the seller doesn't have to bring cash to closing or do a short sale and have the bank take less, but then the bank chases after the seller for the difference, for what they call a deficiency. And so that's why this is a really interesting solution. Now, I'm going to give you another bit. I'm almost done with all this. Another little bit here is that in the old days, called the old days, 70s and 80s, they had a thing called a non-qualifying assumption. Non-qualifying assumption. They also had things called qualifying assumptions. What's the difference? Well, a qualifying assumption, this buyer has to completely qualify financially with the bank who has the note from the seller's old loan. So the buyer has to go into the seller's bank and get permission to take that note over. That's called qualifying. And as long as the buyer can qualify, they can do it. The bank is typically going to allow it to happen because the bank wants this loan to just keep moving forward. Now, again, in the 70s, 80s, they did all kinds of things where over time, the bank started to add clauses that you had to qualify, clauses that you had to pay off the note if you sold it, unless there was a qualified assumption, because people were doing weird wraparounds and all kinds of things. It's all flashing back in my head, maybe yours too. Anyway, that's a qualified assumption. They also had a thing called a non-qualifying assumption, which was really cool if you were an investor. The non-qualifying assumption used to be an FHA loan in particular, but could have been a conventional, but a non-qual. The non-qual, this buyer didn't even have to qualify with the old lender. They just had to sign a paper that they would take over and be responsible for the note. Problem with that is the seller was still on the hook, but it did get the property sold, and this buyer moves forward. If you look at your, either, it depends on where you are, but your state real estate contract, if you look at your, or maybe your association or whatever, if you look at your contracts, there are probably clauses in there that talk about assumptions, okay, because it was a big deal. And the second part of all that, the other thing you got to get good at if you get into assumptions is, what if the seller has some extra equity? Oh, let me finish before I go into extra equity. The non-qualifying assumptions were happening in the 70s, 80s, where this buyer could just take over the note and run with it without qualifying with the bank. The banks got rid of all that, okay? The banks, either if they had their own notes, they wrote it out, or for the U.S. at least, they went to the federal government and had the federal government write it out of the FHA and VA loans. So it's no longer there where they can just take it over without qualifying with the bank. So everything moving forward is going to be a qualified loan, which means the buyer has to qualify for the assumption to take over the seller's old loan and move forward with it. That's something that you'll have to deal with and you'll have to learn if you get into this market, but it's not as difficult as you think. It's actually Pretty cool, because there's already a process to do it. In fact, people are already doing them today. Okay, so it's something to think about. No more non-quals. There are qualified assumptions, and they're happening. Here's the question: what if the seller has owned the property for a little bit and they actually have some equity, or maybe they've owned it for a long time and they've got a mortgage and they've got some equity. They got this low interest rate old loan that they can have assumed, but they got some equity in there that they want to get back. There's a couple different ways to deal with that. Number one, the buyer can come with a lot of cash. Not likely to happen, but the buyer may have cash, but probably maybe not a lot. Depends on how much this seller's equity is. The other solution is the seller can take a combination of cash and seller carryback. Seller carryback, seller note. The seller becomes the bank for part of the financing. So the seller will walk away, but the seller will continue to get some payments over a period of time, either a long period of time or a short period of time, balloon payments. There's all kinds of things that you can mix into the equation. By the way, you get very creative. This is where creative financing really took off in the 70s and 80s, was this part of the equation. How do you deal with this equity piece? And it got very interesting, and you got to be safe, you got to protect your people and whatever, but it's pretty cool. It allows solutions that our market is not allowing right now because of all the weird dynamics. So it's something you may want to start investigating. Anyway, so there's the seller carryback is where you're going to find it in your contract if you want to learn about it. In my state, in Colorado, not only do we have it in our contract, we actually have all the forms, approved forms by the state to do a seller carryback. We have the promissory note, we have the deed of trust in our state. It could be a mortgage in your state, but we got the deed of trust, different types of them you have to learn about. Anyway, that is a solution that I think is going to actually start playing out. And if an agent is smart enough to see this opportunity, first of all, they can go to sellers probably in their sphere. This is a repeat or referral, most likely. But then you can also even start marketing this out once it starts taking off. But you've got this opportunity to go to your person and say, hey, look, I know your home's not selling right now or not selling for what you want. Why don't you consider this assumption? I'll show you how it works and we'll walk through it. We'll talk to your bank, get the assumption package and see what the rules are. And make sure that you get a release of liability, Mr. and Mrs. Seller, and then make sure you do. That's probably going to be part of your contract. If not, it'll start working its way in. You need to put in additional provisions. You may need to get an attorney involved to help you with these initially. We'll see. Depends on how far your state is in advancement. In any event, you talk to that seller about this idea, and the key is the seller can sell. The seller can maybe sell for more. If the seller doesn't have to take a hit where they come up with a lot of cash to close, the seller doesn't have to take a hit on their credit if they're going to do a short sell instead. And by the way, those things follow you along just like a foreclosure. So it's really rough for a seller to go through all that. It's a solution. It's a possible, they can sell for more than the market because the turns, if you start running the amortization schedules, the buyer's probably going to be ahead because this mortgage now only has 27 years left or 25 years left or whatever. It's going to pay off faster. And if you do all the payments over time and bring it back to today's amount, you total all those up, it's going to probably be a lot less than whoever's paying a 30-year at the double the interest rate, even though they may be able to buy the property for less. If you're just going to have to do a lot of math. If you're okay with math, you're going to love this environment. If you're not, get somebody who is and team up with them, because I think there's going to be some cool opportunities there. Anyway, that's my hot idea for today, to start looking forward in this market. And is there an opportunity with assumable loans? And by the way, before we go on anymore, I should have said at the beginning, I am not giving any financial advice. I'm not your attorney. I'm not your financial advisor, nor am I for any of your clients. I'm just bringing up an idea that you should investigate and check out. All right, so let's do this. I kind of threw an idea out there. I spent a little longer than I usually do, but I've got some people here that obviously are kind of interested in this. Let's hear what you all think about that idea. Go ahead and unmute yourself and tell me, what do you think about this assumption stuff? Do you think this is viable? Do you think it's something you'd want to learn about? You think it's going to have legs? Or do you think I'm just full of hot air and it won't work? Go ahead and unmute yourself and let me know what you're thinking. Anybody got any thing you want to throw in on assumptions? Had any experience with assumptions? Think there's a pitfall with assumptions? Think that they have any benefits or any liabilities? Anything you guys think about assumptions? Because I think it's something that's going to start popping up in your markets if things continue the way they are. Go ahead, unmute yourself. Let me know what you're thinking. Okay. Let's see. Oh, Lynn said, hey, sorry, my video's not working. Hey, thanks, Lynn. I'm looking at chat here. I can't talk because I'm taking care of my mom. Hey, cool. Hey, thank you. I do. I appreciate you too, Lynn. Thank you so much. All righty. Well, let's do this. Let's go into the next section. Well, the idea is out there now, right? At least you can mull that through your head a little bit. Let's go through the next section, which is phase 2. We're going to talk about repeat referrals, and we'll talk about anything that you want to talk about as far as how you could advance your repeat referral business. Are you working on any projects? Are you running into any challenges? Any victories or things that are going right? Go ahead and unmute yourself and let me know what you're thinking or what you need help with on repeating referrals. All right, we'll move into phase 3. And by the way, you can still ask one of those questions if it pops in your head. Phase 3 is this. Phase 3 is your entire real estate practice. Is there anything that you would like to talk about in your entire real estate practice that we can spitball and throw around that might help you move forward? Either a project that you're working on, a challenge you've experienced, something that's working well. Anything that you want to chat about in your real estate practice. You got a little brain trust here. I see some people on this call are pretty smart. So if you got anything, go ahead and unmute yourself and get it out there. This is an opportunity for you to get some answers to maybe some questions you've had about anything relating to your real estate practice. Go ahead, unmute yourself and let us know what you'd like to know, what you'd like to talk about. Excuse me. Whew. All right, I'm looking over in chat and I do see Lynn. Thank you, Lynn. Lynn is got, I think I'm going to read this. I hope I got this right. It says, any ideas other than the updating my database are RE, very long lost past clients. Okay, so I think what I'm reading from this is how do you reconnect with your long lost past clients? Lynn, if that's right, yeah, okay, good. Yeah, so Lynn says right in the comments. So how do you reconnect with your past clients? It's a good question. We all go through it. I'm sure I depend almost all. I'm trying to think if there's anybody I've ever met who didn't do this. There are a few, but most real estate agents make this common mistake, which is, and I did too, which is, you get in the business and you're trying to get a deal and you're trying to get a deal because, you want to make a deal. And then you help somebody buy or sell a home and then you have a great time and you close and then you kind of forget about them because in the back of your mind, they're probably not going to move for another 5, 7, 10 years. But you need to eat today, so you got to go find the next person to talk to. And so it's very common for us to forget about them and to go move on to the next transaction. And then the problem is, though, the time elapses. And before we know it, we haven't talked to that person for 3, 5, 7, 10, 15, 20 years. Uh, yeah, well, here, never just got too busy. Lynn says, I didn't forget, just got too busy. Yeah, that happens too, for whatever reason, or the variety of reasons. The bottom line is there's all this time that's elapsed. And now, oh my gosh, how do you break the ice? Well, I went out and I've asked a whole bunch of top agents, what do they think the solution to this problem is? And I got a lot of different answers, but most of them came back with the same idea, which is something along the lines of this. You've got to just swallow your pride for a minute. Your biggest thing is your fear, right? You're afraid you're going to reach out to them and say, hey, Charlie, hey, Sally, how you doing? And they're going to say, who are you? Or, you haven't talked to me. Why are you calling me now? Or, we think there's going to be some ugly reaction. Maybe they hang up. I don't know. We're afraid that something bad's going to happen. And the common solutions I've heard is, one, just start marketing to them like there was no time gap. I've had top agents tell me that works. You just start marketing like you would to everybody else. You just start doing things. The other one is that was more common, though, is more of a direct approach where you call them up. It's typically a phone call, and you say, hey, I don't know if you remember me. I'm Mike with ABC Mortgage, ABC Realty. I helped you buy your home 7 years ago, and I lost touch with you. I just feel terrible, but I've been wondering lately, how are you doing? And they just, you kind of say, I screwed up, and you jump in. Now, some of them will do a very long-winded message on that, and some will do real short, like I just did, say, well, I think I messed up by not staying in touch, and I'd like to rectify that. I'd like to get back in touch with you. And how's the house? How are the kids? Are you still living in the same place? I mean, did the kids get bigger? Did you get the dog you were looking, whatever you can remember about him? Did you get the job transfer or the job promotion? Or I don't know. You just start a dialogue typically about the family, right? And do the forward, which is family, occupation, recreation, or dreams. Like if you were going to call me, ask me about mountain biking, and you're back in my inner circle, I mean, that's recreation. We'll talk all day long about that. So if you can remember anything about them to kind of clue into the conversation or clue into the house. Oh, does your house still have the purple walls? Or does your house still have all the purple carpet? I tried to sell a really high-end house one time, had purple carpet everywhere. I couldn't get it to change it out, and we couldn't sell the home because of it. But anyway, so is there a connection with them on some item to start the conversation? Another one I had, by the way, these are all real, I'm thinking of really sharp top agents. Guy down in Colorado Springs. Great guy. I'm trying to remember names. I always forget names and remember faces. But anyway, his approach was he blamed it on his database. Okay. So he calls up and he says, hey, Lynn, this is Mike Cerrone over at ABC Realty, and long time no chat. I know it's been a while, but I just want to apologize to you. I had a database problem. My database wasn't working right and wasn't staying in touch with you, and I just discovered it. And I fixed it, but I wanted to call and touch base with you and just let you know that I'd like, with your permission, I'd like to reach out and continue to touch base with you and see how you're doing. Is that okay? And he said, most people say, yep. And then he just go in whatever you want to. The key in that conversation, by the way, is just to make a reconnection. Don't even bring up real estate. If they do, great. We can talk about it, but your first conversation is just a reconnect. Ask them how they're doing. Ask them how the family is. Ask them how their spouse is. Ask them how their kids are. Ask them about their dog. Ask them about their activities that they like to do. Whatever, any connection you can remember is good too. And there you go. You're off to the races. And then you just reconnect and go, hey, I'm going to stay in touch with you. Is that all right? And they say, yeah. I say, great. And then you put them in your database. You do your follow-up after that, whatever your plan is. Hope that helped. That's kind of the common one I've seen. Anybody else? we got other smart people here on the call other than me. Why don't you unmute yourself if you got any ideas for Lynn on how to reconnect with a past client, a neglected past client. I don't know, we either have a tech problem or we got shy people today, but we'll keep rolling. All right. Well, Lynn, if that helped, or if you have any other questions, go ahead and type them in. I know you can't talk right now because you're trying to keep the room quiet, but oh, there we go. Thanks, Mike. Keep on keeping on, even though no one talks today. Yeah, that happens. That's okay. I understand. I like to go to meetings and be a fly on the wall. I get it. It's just that the meetings are more productive and they're more fun if we can get some banter going, because we can talk about what you want to talk about. In fact, I'll offer that in the next couple minutes. If you can type really fast and you would rather type your question or whatever in the chat instead of unmuting yourself, go ahead and do that. So far, I think I'm just seeing Lynn, and I'll give a minute on that. And then if we don't have anything, we'll wrap up, but I'll give us a minute. I see Dave's with us. Dave had a problem last time with his technology. He was trying to talk to us and wasn't working, or maybe it was our side. I don't know. But Dave, you could tell us, how is Canada going? Our friends to the north. I don't see him coming in. Let's see. Oh, that's okay. So Lynn's got another question. Cool. Thank you, Lynn. Let's see what we got here. A new topic. Oh, Dave says problem is too expensive up in Canada. True. Dave, you should consider some of this assumption stuff I was talking about. I'm not sure what the rules are up in Canada, but it's worth a quick investigation. All right, let's go into Lynn. Lynn says, new topic. 2 new agents want to join my team. How to best focus their energy beyond OH and showing buyers, open houses and showing buyers, SOI and rentals. Well, I mean, you got a good list there. In fact, I've been looking back at the idea of open houses. That may be a way to find some motivated buyers on the cheap right now, especially mega open houses. Remember, whenever everybody's going left, you want to go right. You want to do something a little unique and different. Let's see, showing buyers. Well, that's always good. That's where the power is right now. If you've got a motivated buyer, let's see, sphere of influence. That's the base and the core of everybody's business. I definitely help those new people map out their list for their sphere. They don't have any past clients yet, but their PCSOI, map out their list and map out a plan. That's going to eat up a nice week or two for them to get it all mapped out, because that is going to be the core of their business moving forward. And then rentals. Rentals is not a bad idea. It's a lot less money, but it's a market that continues to flow. And it may be a market you have to move into to get you over the hump as things are getting shaken out in the real estate industry, right? You want to look for those alternatives. Okay, and then Dave, I'll come back to Dave. So not sure if I'm answering your question, Lynn. Let's see, new topic, 2 new agents want to join my team. How to best focus their energy beyond open houses, showing buyers, sphere of influence, and rentals. The other thing you could do with them is, if you've got some really strong people, they're not afraid of things. And new people tend to have a lot more courage than the rest of us. Sounds crazy, but they do. You could get them into going after for sell by owners and expireds. Those are markets that are always in need of the help of a good agent, especially if you're experiencing one of these changes in the market, right? They heard about their friends selling FSBO last year or 2 years ago and got mobbed, and agents and buyers were throwing themselves at them, and now they put their home up on the market and no one's showing up. It's a little frustrating. So they need a friend. So have your people go out and start working relationships with FSBOs. Not a one and done, but relationships. Go meet them. That's where open houses are coming back in, by the way. Do an open house on the FSBO's property. Do a mega open house. Show them how you're going to promote the property. You're going to pick up some buyer leads, maybe some neighbors for some seller leads. And you've got this FSBO now who's like, wow, this agent is actually going to work, because they go FSBO for a lot of different reasons. One, they just don't know an agent, right? Or two, they know too many agents and they can't make a decision. And sometimes it comes to the bottom that they hate agents, but that's not always the situation in my experience. So a lot of them think we're lazy. So if you get in there and you're working really hard and open, that'll open them up. So that might be something for these new folks to do. Knock on doors in apartment complexes. For instance, that's how I'm pulling mind blanks today on names. It's been my weakness forever. But that's one of the top agents I'm thinking about. She got her start by doing door knocking in apartment complexes. And in fact, another guy up in Chicago, she did it down in Louisiana. She did like 40 units her first year, and he did 20. Both of them were just knocking on apartment doors, talking to people, seeing if they want to buy a home instead of rent. Right. So there's an option. Ken, I don't know if I helped you out there. Oh, and my dead leads? Yeah. Oh, always. Yeah. If you're a very busy agent, a new agent, of course, can eat right out of your trash can. Oh, he sounds terrible, but you're dropping your dead leads, or leads that aren't strong enough for you. They can pick up on those. All right, Lynn, I hope that helps out a little bit. If you have any specific questions, let me know. Dave is talking about Canada. He's up in Ontario, and he's saying, hey, the prices are way too high up here, and they're experiencing sliding. That's what I've heard. That's why I kind of want to hear from Dave. But their average price is $1 million up there in their market, and it's starting to slide a bit. And so there's a lot of fear. And there was a lot of excitement. There's a lot of fear. Remember, when there's ever fear, the beauty of being a real estate agent is there's always an opportunity. You just have to identify it and have enough courage to move into that, and flexibility. Somebody always needs us and needs our help, whether the market's going up or down. And the other beauty of a down market, or benefit, is that people need us so much that they will pay us more. I just had a guy send me an email, and he was arguing that in his market, it's hard to find FSBOs and expireds right now because it's a tight market. And he's seeing all these agents dropping their commissions to be competitive, because that's the only thing they have left. If you don't have any specialized knowledge, then yeah, the only thing you have left is price. So that's why you always want to do a niche and get specialized knowledge, because then you increase your value and you can charge more. People will pay for value. They will not pay for no value if you look like a commodity. So he was saying he thought commissions were going to get squeezed down to, I won't say the number, but a very, very small number, and that agents were going to just get crushed. And that happens. That happens all the time in every hot market. I've never been through it. I've been through multiple hot markets now in 30 years. The agents get crushed down as far as their commission rates. But here's what you forget. When the market slows down, the opposite happens. The commissions start to inflate, because it takes longer to sell properties. It takes more expertise. You start to have expired listings. You start to have buyers that are taking forever to find a home. You got all these dynamics that are lengthening the time, and therefore the commission starts to grow to compensate. And so, yeah, in a super slow market, commissions are much different than when it's a super fast market. So keep that in mind. The people that survive actually do very well if they can figure out a good, strong niche to get into and become an expert at. That's why I was throwing out my idea at the beginning. How can you get into something that other people either aren't going to do, don't understand, or won't do, but it's going to benefit your client, benefit people? Then you have an expertise that people are willing to pay for. They're willing to hire you for it. They're not going to beat you up on your commission if you're doing something unique that nobody else can do, like the assumption, right? In fact, they're going to pay you a premium because you know how to do these things and nobody else can figure it out. Make sense? Okay. All right, what else do we got? Let's see. And again, you can unmute yourself at any time, by the way. Dave says, yeah, you need $200,000 in income now to buy the $1 million house. And he says, got low inventory problem. Dave, you're about to have a change over the next 12 months, in my opinion. If this market continues, that low inventory problem is going to flip-flop and you're going to have a high inventory problem. I think, personally, that's what I think is going to happen all across the U.S. There's just too many mega trend dynamics happening where it's not going to happen. We got shot up in this bubble over the last 2 years, the financial bubble, with all this free-flowing cash coming into the market. The Fed and the central banks in other countries, they were pumping cash into the economy. They're printing money. And when you print money, it devalues money. And when you devalue money, then assets rise in price. Well, you can't just reverse that overnight. It's not like they can suck the money back in. By the way, there are mechanisms for it to do that. But again, as I mentioned earlier, they're very brutal and very difficult. So they tend not to do that. What you're going to see, though, is that affordability problem. Dave, you said $200,000 income. Most people ain't there. And so you got an affordability problem. And so the only thing that's going to happen is those people have to now, everybody's got to start earning $200,000, which is not likely to happen. Or interest rates have to go way back down, so it's no longer $200,000, but you can buy it with $100,000. Okay, that's not likely to happen if you're watching all the presses, the financial presses. And so the only thing left is prices to come down to create some affordability. Be prepared for that. Be prepared for that personally, and be prepared to talk to your clients about that. It may or may not be happening in your market right now. Look around and see what's happening in these other markets. Don't think that you're not going to be affected by this massive trend. As I said, back in the last Great Recession, it was caused by subprime mortgages and overextension and over leverage by the banks and everything else. But that thing, it took a long time to slide down. Real estate doesn't move as fast as the stock market. So depending on where you were in the country, I talked to people in 2005, they were crashing. And when we weren't, where I was in Denver, we didn't happen to 2008. It took years before it got worked into my market. But I talked to people who got hit in 2006. I talked to people who got hit in 2007. And then sure enough, it hit us in 2008 and pretty much everybody else in the country by then. Your local economy, how many jobs there are and the employment, always watch your employment. That's what's going to affect more than anything else. Now, these interest rates, though, they're kind of an overarching thing that affect everyone around the country because when those interest rates are high, mortgages are high, the payments are high, it affects everybody, no matter where you are. So that's why I think it's a bigger trend. It's going to start pushing down. And again, it creates that affordability gap. We got shot up that 40% over the last 2 years during the pandemic. Some markets as high as 60%. That's a huge increase in the values over a short period of time when we were already at the peak. We were already moving up and about to come back down at the end of 2019. And then COVID, shook things up and shot it even higher artificially. That's why I believe it's a bubble and it's going to be deflated. The stock markets already did a lot of theirs because they can move quicker. Real estate takes a slower time to move. My opinion, that's what we're going to see. I could be wrong. Maybe some other, again, it's going to be one of the factors. What else could it possibly be? You got to assume that people are going to make a lot more money all of a sudden. You got to assume that interest rates are going to just drop. Now they could, but not with the way the Fed's talking. But I just don't see interest rates dropping. And the only last part of the variable is the prices to drop. Anyway, that's my thought there. Look and see if I've got any other messages. I'm not sure what that means. I'm sorry, I don't know how to run this thing. I got a direct message, but I don't know how to read it. Sorry, I can only read the general messages. I'm not smart enough on this program. All right, well, hopefully we helped a little bit in some way today. I'll leave you with this. Look into all the opportunities that are available to you. Talk to old timers, do your own memory, read books, What did they do when they experienced these problems with other time frames? What did the people then do to solve the problem? That's probably going to help you get through these challenges that you either are or are about to experience more of. My recommendation is try to think, what would you do in a slow down market? We're already in a slow down market in most of the country. Well, at least half the country. Slow down market. And a market, what that means is that it's taking longer to sell. Prices, so longer on the market, no more multiple offers. There will be multiple offers, but they'll be very rare. Super prime properties, but other than that, no multiple offers. Instead of, a lot of my career, it was taking 4 and 6 months to sell a home. I mean, sometimes I had listings for a year. I mean, we're going to go back to that. How are you going to adjust your business model to that kind of environment where you have to have the tenacity, the longevity, the endurance to last a year on a listing? You got to start thinking about those kind of scenarios. That's why I'm saying, well, maybe you start working with first-time buyers to help shore up the difference and to get some more immediate cash while you're waiting for your long-term listing to close out. These kind of things. Start picturing, how can you win in this market? That's the key. I know it sounds like I'm doing a lot of doom and gloom, but I'm just trying to be realistic and say, where is the opportunity? I'm trying to forecast where's the opportunity. And that's what you need to be doing. Where's the opportunity? It might be in what I started with, which is assumptions. You might want to investigate that. Or I gave you some other things: REO, short sale, investors, first-time home buyers, and then you also always have motivated buyers and sellers for whatever reason. That's kind of out of your sphere. And those are the groups that you're going to want to talk to. FSBOs and expireds would be motivated sellers. Potentially, you're really going to have to qualify your buyers and sellers as well. What is their motivation for doing whatever they're doing? That's going to become critical now that there's no profit greed motive. It's going to be, I need to buy or I need to sell because of X, and it better be a good X. Otherwise, you're not going to want to invest your time and money into the project. All right, hope that helps. Thank you so much for joining us today on the Referral Mastermind call. I hope it was valuable. Hope you have a fantastic and productive week. Take care. Bye now.